Does that say tax alchemy on the back? I like his light.
I'm Jamie O'Kane, CPA, Small Business Advanced Tax Planning and Compliance Extraordinaire, and this is the Abundant Beans Podcast, the podcast that takes my love for learning what makes people tick while digging into the good, bad, and ugly of small business ownership. We strive to give you the insight that only those in the trenches of being and working with entrepreneurs can provide.
Let's go over tax write-offs for new business owners. There are 5 main write-offs that every new business owner should be taking on their tax return. So of course I'm going to spend some time to make sure you have them. And starting off with number 1, write off your phone. If you're on it right now, you better be writing off your cell phone. And if it's in your business used for more than 50%, the government lets you write it off. Number 2, make sure you're taking your meal deductions. Meals are 100% deductible in 2021. Number 3, write off your vehicle, because if you have a vehicle that's used more than 50% of your business, the government lets you write off your vehicle, and that's a big deduction. Number 4, place your children on payroll. The government allows you to pay them up to $12,550 in 2021 without them needing to file a tax return. And last but not least, do not forget your equipment, and that includes your camera, lights. I want to make sure that you're documenting everything. Follow for more tips.
Phones, we don't care. It's de minimis. Phones are small. Doesn't matter. I think very recently the IRS was like, we don't really care if you allocate business and personal because we know it's all happening at the same time. Okay, meal deductions. Let's talk about meal deductions. In 2021, you could write off 100% meals taken in restaurants for a business purpose. That's different than his bag of chips. So it's not any meal. It's specific meals for a specific purpose, which was send people to restaurants so that they don't all die in 2021. So a little more detail needed on that one. All right, this is the one that drives me absolutely batshit crazy. I think Steven knew that. That's why he gave me this one. Vehicles. Let's talk about vehicles. There are many different ways that you can write off your vehicle or be reimbursed for your vehicle use. But there's also, it's not that straightforward. Just because you use your vehicle for more than 50% business use doesn't mean you should be completely putting the vehicle in the business name and 100% deducting it. You can't do that. It has to be based on business use. And then what happens when you take it out? It's a disaster. Usually a tax disaster of recapture. And if it goes under 50% use, then you have to recapture all that depreciation you took in prior years. So vehicles can be a very big headache if you put it in your business and you're deducting it. It's not 100% business use. What we suggest for our clients most of the time, because it's not 100% business use, is for them to be reimbursed their mileage every year for their use of their vehicle. Over the long run, a lot of the time, that's actually way more beneficial, and it's a lot less headache. So I hate vehicle deductions. This one it's lazy, and it's also can create a lot of complications that are just not necessary. Just get reimbursed for your miles. Super easy, super straightforward, and in the long run, generally a better deal. Also, we're just taking one big deduction in the year. I'm not going to take it over multiple years. It's going to hurt next year. This is a good one. So equipment's important to make sure that you're tracking. But again, we go back to depreciation. So most assets or assets over $250,000 or $200 or $2,500 should be depreciated. And there's elections to make to completely expense those in the first year if you'd like after purchase. But then we end up with, again, a ton of deductions in one year and none in the next years. So if you're just starting your business, a lot of the time, because we work with a veterinary and they have a ton of equipment, we'll look at their income and what we think their income is going to be over the depreciable period, and to decide if we're going to take those deductions in the first year or not, because a lot of the time it's just a loss that we can't do anything with. So there's future planning to be done with how you deduct your equipment.
Thank you so much for listening or watching. Be sure to subscribe on YouTube, iTunes, or wherever you prefer to listen. If you learned something and found some useful information to apply to your business today, please consider giving us a thumbs up and a review. Until next week, be abundant.